Warren Buffett, often referred to as the Oracle of Omaha, is arguably the most successful investor of all time. With a career spanning over 6 decades, Buffett has accumulated vast wealth by making astute investments through his company, Berkshire Hathaway. For those looking to emulate his success, here's a deep dive into the investment principles that have guided him throughout his illustrious career. Understand what you're investing in circle of competence. Buffett is a firm believer in investing in what you understand. He often refers to this as staying within your circle of competence. If you don't understand how a company operates or how it makes money, it's better to skip it and focus on investments you're familiar with. This doesn't mean you shouldn't expand your knowledge. It just suggests that when it comes to investing, it's best to stick to your areas of expertise. Seek intrinsic value. One of the cornerstones of Buffett's investment strategy is his focus on intrinsic value. He endeavors to determine a company's genuine worth based on its fundamentals, such as earnings, dividends, and growth rate, rather than its current market price. If the intrinsic value is significantly higher than the market price, it might be a good buy. Look for companies with a competitive moat. Buffett loves companies with a competitive advantage or moat. This moat ensures that the company can fend off competition and maintain its profitability over the long term. A moat could be a strong brand, like Coca-Cola, patent protection, regulatory advantages, or even a network effect. Be patient, Mr. Market. Analogy? Buffett often uses the analogy of Mr. Market to explain the stock market's volatile nature. Imagine a moody partner who offers to sell his share of the business or buy yours every day at different prices, influenced by his emotions. Some days he's optimistic and quotes high prices, and on others he's pessimistic and offers bargain rates. Smart investors, according to Buffett, will ignore Mr. Market's moods and only buy or sell when the price is right for them. Think long-term Buffett's preferred holding period for an investment is forever. While it's unrealistic for most investors to hold onto stocks indefinitely, the key takeaway is to adopt a long-term perspective. Avoid chasing short-term gains or getting swayed by market noise. If you believe in the fundamentals of a company, stick with it through the market's ups and downs. Price is what you pay. Value is what you get. It's essential to differentiate between a stock's price and its value. Just because a stock is cheap doesn't mean it's a good buy. Similarly, a high-priced stock isn't necessarily overvalued. Buffett advises buying quality companies at a reasonable price rather than opting for average businesses at bargain prices. Diversification isn't always essential. Unlike many financial advisors who preach the importance of diversification, Buffett believes it's better to have a few well-chosen investments than to spread oneself too thin. As he often says, diversification is protection against ignorance. If you're confident about your investment choices and have done your due diligence, a concentrated portfolio can offer substantial returns. Avoid high debts. Buffett is wary of companies with high levels of debt. He believes that businesses with minimal debt are better positioned to weather economic downturns and are less likely to face financial distress or bankruptcy. Reinvest dividends. Instead of taking out dividends, Buffett often prefers to reinvest them, capitalizing on the power of compound interest. Over time, reinvested dividends can significantly boost your investment returns. Stay away from speculation. Buffett draws a clear line between investing and speculating. While investing is about analyzing a company's fundamentals and making informed decisions, speculating is more about trying to time the market or betting on price movements without any solid underlying reasons. Investing like Warren Buffett requires patience, research, and discipline. It's not about jumping on the latest stock market trend or seeking quick wins. Instead, it's about understanding a company's true value, having faith in your decisions, and thinking long-term. While not everyone might have the same success as Buffett, adopting his time-tested principles can certainly set you on a path to better investment outcomes. Cultivate a temperament for investing. Buffett has often emphasized the importance of having the right temperament for investing. The ability to remain calm and rational during turbulent market conditions is crucial. Emotional decisions often lead to buying high and selling low, which can erode returns. Instead of getting influenced by the market's daily fluctuations or headlines, focus on the broader picture and the fundamentals of your investments. While this may not directly relate to stock investing, Buffett believes the best investment you can